Ted. All right, beautiful. So what I want to share with you this evening, I hope you're all seeing seeing the PowerPoint. If you are seeing it, please open your mic and just let me know.
I can see Edson.
All right, beautiful.
Yes.
All right, so this evening I wanted to share with you some pertinent information about some simple things as well as more technical things that we as tax preparers and CPAs look at your tax returns. It's helpful to know how the tax return works. Everybody has to deal with it sometimes, every year. Everybody has to deal with it, even if children do not have to deal with it now, or they think they don't have to deal with it. They still have to deal with it now and later. So what I wanted to do was just to go through the tax return with you for you to understand how it works and so on and so forth. So just a little bit about me. That's somebody assisted me to get this done. My assistant helped me, so. And I like this little thing here that she puts on here. It says, beware of little expenses. A small leak will sink a great ship. All right? Beware of little expenses. For those of you who have some Jamaican background with you, you might have heard some Jamaican parables. What is it that brings to mind? What is the saying that brings to mind? You don't know? No? Okay. Anybody online? What saying does that bring to mind?
Wise and pound foolish.
Sorry?
Penny wise and pound foolish.
Penny wise and pound foolish. Okay, that's one of them. Beautiful. Any other?
Every mickle make a muckle.
Every mickle make a muckle. There you go. Every mickle make a muckle. All right? And I've been using that statement so often over the past few weeks because you still have to be cognizant of every single little thing, because guess what? In my field of work, what I do is I look at all my businesses, all my clients, I look at what they're spending their money for. And then what I do is I give them advice as to where they need to tone down, where the biggest expenses are, and how to fix those things. All right? So that's a part of the accounting portion, but we're going to focus on the tax. A little bit of the accounting and the consulting and the business organization that we do will also come out in this evening's presentation. All right? So we're going to pause here. We're going to get a word of prayer. We're going to have a word of prayer, and then we're going to go into what I have to present for you. Let's pray. Our loving Heavenly Father, what are we without you? And Father, we know that you care about these things because you told Israel that you're a God that is right beside us. You're not a God that is far off. And everything that bothers us, everything that troubles us touches the apple of your eyes. And yes, money bothers us, taxes bother us, and therefore it is important that we understand how these things work. So we ask, Lord, that as we seek to educate our own people, as we seek to educate the church and people at large about this important matter, that we will be benefited from this presentation this evening, and that we will all go from this presentation having a broader, better understanding of how this tax system in which we live work, and also to better maneuver this system to be able to get the best benefits out of it. We thank you for being here with us. Thank you for taking myself, Alicia, and the people who are here safely. And we ask that this evening again will be a blessing, we pray in Jesus' name. Amen. All right. Let's go back to our screen, our presentation. Tech team, I'm not seeing the screen on the PowerPoint. You guys on the Zoom, are you seeing the screen?
Not anymore.
Oh, okay. All right. I think they said when I'm showing the screen, it will show. All right, there it is. All right. So let's start with some basic information. What is a tax return? So, and some of this is small for me, so I'm going to have to kind of twist and turn a bit. So it says a tax return is a form or forms that filed with a tax authority that reports income, expenses, and other pertinent information, financial information. In the United States, for individuals, the most common form used is IRS Form 1040. Everybody should know that form. That's what your personal individual tax return is filed on. It says on tax return, taxpayers calculate their tax liability. Your tax liability, whether or not you owe the government, is going to be calculated there. Now, one thing I want to, from off the bat, I also always want to debunk some very nonsensical ideas. It is not always good to get a big tax refund. You might ask why, and let me tell you why. Because you are, in other words, when you get $15,000 refund from the government, what it says is that the government had $15,000 for you sitting down for 1 year. You're getting no interest on it, and then he takes it up and give it to you one time. Why we like that is because we like a lot of money one time. But what we have done is that we've restricted our lifestyles or spending opportunity for 1 year just to wait for $15,000. Do you understand what I'm saying? So it's not... Up here? Oh, hold it up here? Okay. So it's not always the best thing to get a big refund. Now, if you're getting other stuff, which we're going to get into, like credits and stuff like that, you will get the credits at the end of the year. But what you've done, too, is that you've taken so much taxes out of your pay, and then you're going to get back some of that at the end of the year. Basically, that's what the refund is. You gave the government some money to hold, and at the end of the year, it gives you back if you did not make so much money that you owe that much tax returns. All right, let's continue. I'm going to explain that more. So on your tax returns, taxpayers calculate their tax liability, schedule tax payments, or request refunds for overpayment of taxes. And that's what everybody loves to hear, refunds. And there are some other details there that you can read from that paragraph. But the next paragraph says, tax returns are not only about reporting income, but it's also about claiming deductions and credits. Let me stop here to explain something. There are two things primarily that causes a reduction in your taxes, your tax liability. There are deductions and credits. Deductions are things that you have spent your money for. That the government says, okay, we can give you back some deductions because you've spent the money on those. I'm going to go into the 1040 and I'm going to pinpoint the line item that you will normally see if you don't have a business that are the deduction lines. Then the other part is credits. What are credits? Credits are things that the government gives you money for. Such as, anybody have any example of what are some of the credits that you hear that the government give you money for?
Having children.
Having children, there you go. Yes, ma'am. Anybody else?
Going to school.
Going to school, yes. What is that one called?
A credit. Education credit, I don't know.
Education credits, and there are two types of education credits: AOC and I forgot the other one because AOC is more popular. American Opportunity Credit and lifetime credits. So American Opportunity Credits is for you pay your tuition, the government gives you back a maximum of $2,500. Lifetime credit, you get the same thing. It's not $2,500, but you get I think it's $1,500 in credits. Now, what's the difference between credit and deductions? Credits are more powerful than deductions. What do I mean? Let's say, and I'm going to give you numbers because I think numbers makes it easy for everybody to understand everything. Let's say you made $100,000 for the year. You are in a 24% tax bracket, which means 24% of $100,000 is how much money? Somebody made the calculation. I give you very quick numbers so you can get it quickly. 10%, 24% of $100,000, how much is that? All right, math geniuses, where are you? I'm not hearing you.
20,000.
24% of $100,000 is $24,000.
Yeah, 24,000.
24,000. Let's say you, so that's what's going to be on your tax return. And no, this is not really how it works, but I'm going to give you an idea of how. All right, let me draw back. You make $100,000, you're married filing joint, you take standard deduction. Remember that word, standard deduction. And remember the word deduction. You take standard deduction. Standard deduction, married filing joint, is $27,700 for 2023. All right? So $100,000 minus $27,700 leaves you with $72,300. Now I'm going to have to take out my calculator. 24% of $72,300 is 0.24 is $17,350. A credit, that's what you owe. That's your tax liability, $17,352. A credit will reduce that tax liability dollar for dollar. So if you have one child, child tax credit now is $2,000 per child. If you have one child, that's $2,000. That $17,352 that we've just calculated has now been reduced to $15,352. If you have two children, it's 2,000 times 2, so that's 4,000. That $17,352 has now been reduced by $4,000, $13,352. Now, how do you get child tax credit? By having kids. But also there's something else called, why am I missing these? Additional child tax credit. Additional child tax credit, now listen to this now, you may need to use this up. Because I believe as Seventh-day Adventists, there are legal ways to get benefits out of the tax system that we don't know of. You can, if you have your mother that you've been taking care of, they have a social security number, they live in the States, and they, you help take care of them, even if it's 50% of the time you take care of them and your brother or your sister takes care of them. You can agree with your brother or your sister to claim your mother on your tax return every single year. That doesn't give you $2,000 though, that gives you $500. But remember, as we said when we started out, what's the Jamaican parable that we need to remember? Every mickle makes a muckle. So if you had owed $17,500 and you get $500 of credit, how much do you now owe? No, you only
17,000.
You hold on. Let me correct something here. So you claimed you owed $17,500. You have two children and you claim your mother. All right, $17,500 you owed. You have two children. Each child, you get how much for each child? $2,000. And how much do you get for your mother? $500. So that's $4,500 in credits that you've just earned for having two kids and you claim your mother. How much do you now owe?
$13,000.
$13,000. So now, but here's the difference. So the power in the tax return is on credits, to save you on credits. But deductions are also a big deal. Because, and I'm going to go to the line item again on the 1040, because here's how deduction works. Deduction reduces your taxes to the level of your tax rate. Let me explain that. Let's say you have $50,000 in deductions. In deductions. Not credits, deductions. And your taxable income or your income is $100,000. That $50,000 in deduction is not going to reduce your taxes dollar for dollar. It's going to reduce your taxes by the percent of your tax rate. So let's do some math now. I have to go back to my calculator again. You make $100,000. You have $50,000 worth of deductions. You're in the 24% tax bracket. So you would do 50,000 multiplied by 24% equal $12,000. That $50,000 worth of deduction will save you $12,000 on your taxes. It doesn't save you $50,000 on taxes. It will save you approximately $12,000. Why? Let me tell you again. You make $100,000 for the year. You have $50,000 in deductions. That $50,000 is going to save you approximately $12,000 in taxes, because you would do $50,000 multiplied by your tax bracket. And if you are in the $100,000 range, you are in the 22-24% tax bracket. Are you with me so far? Online, if you're hearing me and you understand, let me know that you understand.
We can hear you.
Amen.
All right, beautiful. Thank you, Mr. Duggins. All right, so we're going to run on, and there's so much I have to share with you, but I'm trying to make sure So here's some little stuff. We're going to the next. Oh, I forgot I didn't click on this. We're going to the next slide. The importance of accurately and timely submission of your tax return. Now, brethren, I'm going to tell you this. My friends, I'm going to tell you this. You sometimes have no idea what the tax preparer is filing on your tax return. But I'm going to give you a few things to look out for, or to be cautious for. Number one, if they tell you we're going to take our pay out of your refund, be cautious. I'm going to tell you why. And I've seen it in my minute years of being inside of this country. Everybody knows that human beings don't tell the truth all the time. How many of you know that? We don't tell the truth all the time. So here's one of the things that we'll do when tax preparers will do. If you do not have to based on the documents you provided to us, we're going to prepare your tax return, and if you're not going to get a refund, but I'm going to tell you, I'm going to take my payout of your refund. What I'm going to make sure you get? I'm going to make sure you get a refund. How do I do that? By taking credits or deductions that you are not supposed to get. Now, when the government comes back, the IRS comes back and audits your tax return, who is at fault? You. Why? Because you signed your tax return. They are ethically liable for it. Hence, I will suggest to you, brethren, don't just seek, especially if your tax return is a little bit complicated, don't just seek an accountant or a cheap way out. Seek someone who has their certification or their reputation at stake to maintain. Are you with me? Because an accountant, somebody told me that they had their accountant do their tax return, and when they were done, they didn't get a refund. They were promised a refund. They should have gotten a refund. And for the entire year, they didn't hear from them until the next year, January or February, when it was time to file the taxes again. Because what happened is some people will come inside of the country during that time, set up their shop, do the tax returns, go back to Jamaica or Haiti or wherever, and you don't hear from them again. because we come to make money and go. But some of the reasons now, importance of accurately filing and timely submitting of your tax return, avoiding penalties and interest. Now, here's something to note. Late filing penalties is 5% of what you owe. So let's say you file your tax return and you owe $1,000. You're automatically going to be charged 5%. But if you wait over a month or a few days to pay that $1,000, you're going to also be charged interest. Now, I don't remember the exact number, but I think interest is charged at a certain percentage per day with the IRS. But the generous thing about the IRS is, and I always hear this from people, we don't like to get into trouble with the IRS. You're right. Don't get into trouble with the IRS, but I'll tell you something, my friends. The IRS is not a big bad dog you can't talk to. I talk to the IRS maybe every single week, and they are people like yourself, but the IRS gives them guidelines onto under how to operate. You can get a penalty waiver if you are late, but if it's for a good, reasonable cause is one of the reasons. Reasonable cause, all right? If you got a stroke, you didn't find any documentation, you couldn't find a document, nobody knew where documentations are, they will give you a penalty abatement. If it is that during COVID or your house got flooded out and you weren't able to collect all your documentation, you will get a penalty abatement. You will need to ask for it. What happened recently, a client of mine, they had a penalty. I called the IRS. I said, hey, we're requesting a penalty abatement. I have to have and by the way, let me just put this in here. If someone is calling the IRS on your behalf, you have to give them a power of attorney, which is Form 2848. They have to fill out a power of attorney to call the IRS on your behalf. With a power of attorney, it doesn't mean I can make changes on your behalf with the IRS. It means I can hear the information the IRS has for you in their system, all right? Now, I called the IRS the other day. I had my power of attorney, and I said to them, hey, I'm requesting a penalty abatement on behalf of my client because XYZ 123. They run their system right on the phone and issued a penalty abatement right away. They sent out a letter to the client. Penalty gone. But it's always good to timely file. Again, if you won't be able to file timely, everybody know what to do. File an extension. But that comes with a caveat. Here's a caveat. File the extension, but call your accountant and ask them with the documents you have and with the estimated documents that you can provide. Here's the word. Estimated documents you can provide, allow them to calculate if you're going to owe or if you're going to get a refund. Why is that important? Because if you're going to get a refund, it doesn't matter when you file within the next 3 years. It doesn't matter. You're going to get your refund. And if you don't file on time, the IRS is so generous again, they'll give you interest on the money that you did not get by April 15th. Are you with me? If you file after April 15th, even with an extension, you're going to get the 5% penalty for late filing. Are you with me? Well, not for late filing, I'm sorry, for late payment. Not for late filing, late payment. Because the extension grants an extension for filing, not an extension to pay your taxes. The IRS don't care how much or when you pay, they want the money by April 15th. All right, let's run on. The next reason I think we need to file on time, ensure the accurate payment. So your accurate tax returns ensure that you pay the correct amount. You need to make sure you are checking in to make sure you're paying the correct amount. Now, here's something else. Anybody ever heard of the term estimated tax? Heard of the term? Alicia, heard of the term? Yes. Have you heard of the term? Yes. People online, have you heard of the term estimated tax?
Yes.
All right, beautiful. Let me explain how estimated taxes work. If you work a W-2 job, you do not need to file to pay estimated taxes. If you end up owing, then they will charge you a late payment or a penalty for not paying. Depends on how much you owe. If you owe within, like, I think it's between less than $1,000 or less than $2,000, you do not get the estimated tax penalty. I'm sorry, this slide didn't move forward. You don't get the estimated tax penalty, but if you own a business and you get a 1099 at the end of the year, you need to be calculating your income every quarter and paying estimated taxes to the IRS at the end of every quarter by the 15th of the following month after the end of the quarter. So, first quarter ends March 30th. By April 15th, you need to be paying an estimated tax. What's the estimated taxes to calculate and pay? Calculate the amount of money you made during the quarter. Find out your tax bracket by that amount of money and multiply that tax number, that tax bracket, by the amount of money you pay. That's the amount of estimated taxes you need to pay. So, let's say January you made $20,000, and I'm always going to use simple numbers so we can do the calculation simply. January you made 20, February you made 20, March you made 20, $60,000. You're in the 20% tax bracket. 20 times 60 is how much? $12,000. Yes, that's the amount of estimated taxes you need to pay. All right? Sounds like a lot of money, but let's say next quarter you make $60,000 as well. All right? And or you make less. All right? You do the same thing. What it does, it balances out. Now, if you see at the end of the year, if you notice at the end of the year that in first quarter you made 60,000, second quarter you made 60,000, you still paid 12 and 12, 24. Third quarter you made 20,000 and fourth quarter you make $1,000. You can actually not pay any money for the third and the fourth quarter because it balances, it annualizes your income, and then that's what you would have to pay taxes on. All right, let's run on. Still have a lot to share with you. All right, another reason, faster refunds. Anybody like to sit down two months to get your refund? No, we don't. So we like to get it quickly. The next one is that it maintains compliance. You need to timely file, you need to timely pay. Facilitates financial planning. Now, here's something to note, and I will suggest this for every single person online. Now I'm going to tell you this. It doesn't matter what stage of life you are, you need to be doing some level of financial planning. Everybody. You need to be doing some level of financial planning. You need to understand how does financial planning help you, and this is something I help my clients with as well. And then the level that I cannot do, I send them to Chanel or whoever I work with, and whenever they need, and this is the reason why you have to have people in your network, right? You need a team. Recently I met a client, and when I met them, really a mess. So what I did is that I said to them, all right, you need some financial advising. So we sent them to our financial advisor. And I said to them, you have all of this asset floating around there. What's the plan? Da-da-dee, da-da-da. I said, all right, you need some attorney to get some estate or trust or whatever the case is as well. So hence you need a team to be able to share. What I don't know, I send them to whoever is in my network who does that. What they don't know in their network, they send them to me. And that's how we build a very good ecosystem where we help each other. The reason, and I'm going to tell you this, brethren, one of the main reasons why I love what I do is because at the end of the day, I know I'm helping people with some of the stresses that they have. A friend of mine recently, he's now become a friend and I'm calling him my friend. He called me and he said, Edson, I would love to take out you and your wife one day to dinner. I said, why? He said, you helped me to get my house. Those are the things that make us feel good about what we do. It's not just about filing taxes. It's about making sure that you get where you want to go with your objective. And that's where financial planning comes in. And the next line, the next reason to file timely. It says there, often tax returns are required when applying for loans or mortgages. Accurate and timely filed tax returns can facilitate these processes. Do you know how many mortgage brokers I have to talk to on a weekly basis? Because my clients want to buy a house or they want to invest or something because of these, their plans for what they're doing. Let's run on. All right, the types of returns. And I see the time, we're at 6 o'clock. There's so much still to cover, but I'll see what we can get through. I'm going to end the latest by 6:30 so that we can have questions for the next half an hour if you have questions. There are a few types of returns to consider. There's the first one, as we mentioned before, is a 1040. There's some variations to the 1040. There's 1040 SR, which is for seniors. Once you're over 65, you can use the SR. The SR is just a longer form. It's like the 1040 is 2 pages. The SR is about 4 to 5 pages. It's the same information, but it's just broken out way more in, more detail. Now, consider this. If you notice that on my screen in red, single member LLCs file a Schedule C that is attached to the Form 1040. Why is that important? Because a lot of people go and they file, they register a business. They don't know what they registered. They only know that they saw the 3 letters LLC. You don't know what you registered. And I'm going to tell you something. You have to be careful what you're registering. When we go to the other slides, I'll share some myths about some other stuff. All right. So single member LLCs. What is a single member LLC? A single member LLC is a limited liability company registered in a state, for example, Florida, that has 1 member or 1 owner. That company will file a Schedule C. The Schedule C is just a schedule. You still are going to file a 1040, but your your business activities will be on the Schedule C. How much money you made, what did you use the money for, and the net profit. What's the big problem with a Schedule C as a limited liability, single member LLC? The big problem with a single member LLC is that you are automatically charged 15.3% on any net profit that you make. Let's say for the year you made $100,000, $50,000, $40,000. But you spent, of that $40,000 you made, you spent $20,000. Hence, you made a net profit of $20,000. You are automatically charged 15.3% on that money. All right? And there's no way around it. That's just it. What is that 15.3% for? It's actually your Social Security and your Medicare that you didn't pay. Because you were a contractor, you got a 1099. All right? What are the other types of tax returns? There's a corporate tax return, which is 1120. 1120 is filed by the big corporations. Have you ever heard the term C Corps? No?
Yes.
Yes, some people have heard it. Anybody online has heard it before?
Yes.
Good. C corporations file what is called an 1120. C corporations are like big companies like Amazon, Google, Tesla that sell stocks on the stock exchange. The other one is S corporations, and I specifically put what S stands for. S corporation stands for small corporation. C corporations are big corporations, can have unlimited amount of shareholders. S corporations are small corporations that can only have up to 100 shareholders. All right? Now, and they get a K1. Owners of an S corporation get a K1. Let me just share this with you. A lot of clients have come to me and they have said, my accountant told me I'm a single member LLC, I need to change to an S corporation. Let me debunk this misery that it will cause in your life. The tax law says that an S corporation has to give their owners a W-2. So if I own a single member LLC, and here's something, let me also share this with you. Think about the state and the IRS as 2 separate entities. In the state, you may be considered an LLC or a single member LLC, but for tax purposes, IRS, you can be considered an S corporation. If you don't change from a single member LLC to an S corporation, you are what is called a disregarded entity. It means you filed a Schedule C on your personal tax return. But if you change to an S corporation, you have to give yourself a W-2. The IRS recently hired about, I think it was about 100 or about 2,000 revenue agents just to start auditing S corporations. If you don't give yourself a W-2, and I'm going to tell you how it works, brethren. S corporations have to give their owners what is called a reasonable compensation. What is reasonable? The IRS doesn't say. But if you make, let's say again, I guess I like the number $100,000 because it's easy to calculate. Let's say you make $100,000 in your S corporation for the year. The IRS is saying whatever is reasonable out of the $100,000, that's what you need to pay yourself. If you didn't pay yourself a W-2, what the IRS will do is that they will come in and say, all right, in your industry, you should have paid yourself this amount. That's the going rate for people in your industry. Then, let's say of the $100,000, it should have been $80,000. What they will do is they will calculate your taxes on $80,000 and they will say, this is what you owe us. Let's do the math quickly. Let's say you're in the 20% tax bracket. And you should have been paying yourself $80,000. $80,000 times 20% is how much? $16,000. That's on income tax only. That's not Medicare and Social Security. Social Security is 6.2%. Medicare is 1.45%, which is 7.65%. So add on another, so in total that's 6.2, so that's 7.65%. So add on another 7.64. So in total it's 27.65%. So that's 80,000 times 27.65%. That's $22,120. The IRS is not going to care that you really don't owe that money. That's what they're going to tell you you need to pay. Just because you're an S corporation and you didn't pay yourself a W-2. Why is that so important? S corporation, you remember that 15.3% that I told you that you would have to pay when you're a single member LLC? When you're an S corporation, you don't need to pay that 15.3%. You don't pay it. So the government has realized that people knowing this has just been switching to S corporation to get out of the 15.3%. So now they said, oh, I see what you're doing. We're going to get auditors to come in and audit every single S corporation in the U.S. Do you know how many $100,000 notices have been sent out already, brethren? A lot. So hence, these little things, again, every mickle makes a muckle. These little things turn into nightmare. Hence, the reason I will always suggest to you, ask a professional as to how to do what you want to do. Let's move on. The other type of tax return that you can file is partnership. All right? A partnership tax return. All right, let's get, and a partnership, as the word suggests, let me just give you an example again. Look at, I hope you're seeing me on your screen. Here's what happened. State of Florida, IRS. If you are a multi-member LLC in the state of Florida, that's what you are, multi-member LLC. For IRS purposes, you are a partnership. In the state of Florida, under the Florida laws, if something happened, you're going to go to court under the multi-member LLC state laws. But for tax purposes, you're going to go to court under a partnership tax law. Totally different. Won't get into all the details. All right. Now, here's, let's move on. I wish I could have gotten that bigger. Is there a way we could zoom in? You know what? I'm sorry. Let's move. I think we have it bigger on the screen. All right. So let's move on to a 1040. A 1040, as you know, it has different sections, right? Now, it has the first section, which is just your name. Always, and brethren, don't let anybody file your tax return before you going through it, even if you don't know what you're looking at. Even if you don't know what you're looking at, ask questions. What I do when I'm done filing a client's tax return, I have a video call with them. I put their tax return on the screen and I say, all right, check the name of the spelling of the name of your name. Check the spelling of your husband's name. Check your social security number. Check your children's social security. Are they all inputted correctly? If they are, then we move on to the numbers portion. That's important. You need to review your own tax return. All right? Simple put, the system may not allow us to file it if it is spelled incorrectly, which is a good thing. But you too need to make sure that your social security is correct, your name is spelled correct, your address is correct. Why is the address so important? The IRS don't call you. What does the IRS do? They mail you. The IRS will not call you unless you call them. And they say they'll call you back. Right? Right. So they will not call you. Your mail needs to be important. All right, let's run on to the next section. Income and adjustments to income. All right. The first line on a tax return is for your W-2. That section there that says 1A, that's for your W-2. All right. Household income, employee wages, tips, Medicaid, waiver payments, and all of those are there. Now, what the tax law says as it pertains to income, every U.S. person needs to report your global income. So if you're in the U.S. and you have land in Jamaica, and you have a business in Jamaica, you're considered a U.S. person. Have you ever heard that terminology before? U.S. person? Who is a U.S. person? A U.S. person is a citizen or a green card holder. All right? You are a U.S. person if you're a citizen or a green card holder. The tax law says that a U.S. person needs to report global income. It means if you live in the U.S., you have a business in Jamaica, whatever income it is in Jamaica, you need to report that income as well. Now, what they do, though, is that they give you credit for any taxes that you pay in a foreign jurisdiction. You get credit for it on your U.S. Tax return, and you pay the difference. So if I were you, I wouldn't do a business in Jamaica. I would. But I wouldn't suggest it. Reason being, the conversion rate is less. Do you understand what I'm saying? So go to somewhere like Cayman or one of those whose US dollar is less than theirs. So when you pay $5,000 in the Cayman, it's actually $6,000 in the US. You understand what I'm saying? Those are just some things to think about. All right. So it says report your global income. For those of you who are elderly and you get Social Security, I think the number is 80%. I said I was going to look it up before I came today. I completely forgot. But I think it's only 80% of your Social Security is actually taxable. All right? Now, if you earn income other than the Social Security that is over a limit, I didn't check this, but I didn't remember the threshold. If you earn income that is over a certain limit, 100% of your Social Security becomes taxable now. All right? So you have to be careful that you do not just go out there to work and make a bag of money in your retirement age, because the government does not care about your age when it's talking about taxes. All right? Now, so we're reporting global income. That's the first section. The second section is deductions and credits. I spoke about that already. But I want you to zoom in on line 12. Line 12 on your screen. Can you zoom in on that, tech team? No, you can't? All right, that's fine.
We can see it. We can see it.
All right, beautiful. You can see it. Line 12, and I'm going to go back up the top. As a matter of fact, let's do it in an orderly fashion. If you notice, there's line 2A, which is tax-exempt interest. If you do trading on the stock exchange or you buy bonds, bonds will give you tax-exempt interest. All right, municipal bonds, state bonds, and some other stuff. Bonds are generally tax exempt. And if you buy government paper, U.S., I forgot the proper terminology, but it's bonds and U.S. treasury notes and stuff like that. Some of those will give you tax exempt income. What does it mean, tax exempt? It means it's income that's not going to be taxed. All right? The next line there, 3A, qualified dividends. Dividends is money you get for owning shares in a C corporation. So you go out and you buy stocks in Tesla, in Google, in Microsoft. You're going to get dividends based on their earnings and the fact that you as a shareholder own shares in that company for that period of time. We have 11 minutes to go. So you will get a dividends. That goes on your tax return. Pension, annuities, IRA distributions. Please note, IRA distributions are you get a 10% penalty for withdrawing money from your IRAs and your pensions too early. All right, you get a penalty. And then on top of the penalty, you have to pay taxes on the amount you took out. All right, so you have to be careful. Now, timing is important. Timing is important. Let me give you a scenario. You and your husband working, both of you are making good money, but you wanted to do something big. Maybe the roof fell in, and God forbid you have good income. You don't want to. You don't have the money at the moment, but you have the money sitting down in your IRA. All right, and you have to withdraw it to fix the roof. It's December 29th, and you have to take the money to fix the roof. I would suggest to you, check how much money you made during the year. Maybe in that year, if you own a business, take the IRA distribution that year. Reason being, the repairs on the roof can act as a deduction against the money you take because you have a business that is run out of your home. You get home office deductions. And you can take the deductions and match it against the penalty and the taxes you will be charged. Do you understand that so far? But let's say you want to buy a house or a car and it's December 30th, December 25th, December 20th. You want to buy the house is on the market and you're courting them or whatever, and you do some checks and you find out you're going to owe $10,000 on your taxes. That's fine, you will pay the $10,000. But if you take the IRA distribution now, $50,000, you have 10% penalty, which is already $5,000, and then you are going to go into a different tax bracket. Instead of 22, you might end up in 32% tax bracket. I would suggest wait until the new year, early in the year. Why? Because now for the next year, you can affect your tax situation from the top of the year instead of affecting your tax situation at the bottom of the year. Do you understand what I'm saying? So timing is important when you are thinking about taking tax IRA distribution. Social Security benefits, spoke about that. Capital gains. Capital gains is when you sell something like stocks and you make a profit. Capital losses are deductible up to $3,000 per year. So let's say you buy stocks, you trade stocks, you made a loss of $4,000, $10,000. You get $3,000 to deduct on your taxes. In the current year, you get $3,000. Next year, you get $3,000. The other year, until that $10,000 loss is used up over year. But you get $3,000. Let's run down to line number 12. Line number 12 says standard deduction or itemized deduction. Standard deduction is just money the government takes up to give you to reduce your taxable income based on your filing status. Filing statuses are 4 types. Anybody, jump in. Tell me what are the 4 types of filing status, both here and online.
Married
Single.
filing jointly.
Sorry, say that again, Sister Dyer.
Married filing jointly.
Married filing jointly, that's 2.
Head of household.
Head of household, beautiful. And then there's the other married one where we're not together. Beautiful. What's the other one? What's the
Married filing separately.
Sorry?
Separately.
Yes, married filing separately. Now, here is something to note. All right, before I tell you what to note, let me give you the numbers. Single, $13,850. That's your standard deduction. Head of household, $20,800. That's your standard deduction. Married filing jointly, $27,700. That's for 2023. Every year it goes up. For 2023, married filing separate, $13,850. Now, married filing separate is a penalized status. Married filing separate is a penalized status. What do I mean? I'm going to give you one example. You remember that thing at the top where I mentioned line number 7, capital gains and losses, where I just said to you, if you make $10,000 losses, you can deduct $3,000 in this year, $3,000 in the next year, $3,000 in the other year. If you are married filing separate, you can deduct, guess how much? All of that? No, $1,500 each year. All right? If you're married filing separate, you may not be able to get education credits. The government penalizes that status. Why? Don't know, but I guess they're encouraging you to file together, which is the best thing. All right? So standard deduction is just the money the government gives you to reduce your taxable income. Now, what's taxable income? Taxable income is at line number 15 on your screen, line number 15. But what is it? The taxable income is all of your income minus all of your deductions equal taxable income. Credits, so beautiful question. Somebody here asked me, what about the credits? Beautiful question. There are two sections on your tax return. And when we're learning this in the CPA exam, this is how they teach it to us. They said before tax and after tax. All right? So your credits come after tax is calculated. Your deductions come before the tax is calculated. All right? So to calculate taxable income, there's no credit that goes there. The only thing that goes there is our deductions. All right? So it's total income. Let's say your income is W-2. 1090, not 1099, let's say 1099, business income. Let's say it's also IRA distributions or interest or dividends. All of that is added together. Then you minus your standard deduction. Let's say you're married filing joint, $27,700, head of household, $20,800, or single or married filing separate, $13,850 for 2023. $100,000 minus your standard deduction of $27,700 for married filing joint leaves you with $72,700. That now is your taxable income. That is what that is what your tax is calculated on. Now, how do you determine your tax bracket? Not what your taxable income is, but what your total income is. All right? Total income now is W-2 income, interest, dividend, capital gains, business income, Social Security, all of those things. Total income. That's where your tax bracket is. So let's say you have $200,000 in income, $50,000 in income. Your tax bracket based on the $50,000 is going to be around 18%, 18%, I think. That's just off of my head, the top of my head. Let's say it's 18%. But you have let's say $30,000 worth of deductions. Then your tax will be calculated. I guess I will have to have some numbers to share this with you. What's left? So you have $50,000, $30,000 is taken out. Your tax is 20% of the $20,000 that's left. Let's say you fall in the 20% tax bracket. It's 20% of what's left. But here's how the tax bracket is really funny. And I realize I have 3 minutes left. The tax bracket is not that straightforward. The tax bracket says if you make from between $10,000 to $60,000, it's at this percent. Let's say 12%. If you make from $60,000 to $70,000, it's 15%. Let's say you make $70,000. It is the first bracket plus a portion in the second bracket. What it does, let's say from $10,000 to $60,000 is 10%. But from $60,001 to $80,000, it's 15%. How the tax bracket works is that $60,000, if you make $70,000, $60,000 is going to be taxed at the 10%. Then the next $10,000, if you made $70,000, is taxed at the other bracket. Do you get what I'm saying? If you get what I'm saying online, please let me know.
I'm following.
Yeah, yeah.
Get it.
All right, beautiful. Let me say it one more time. Let me say it one more time so you get it. If the tax bracket says from 10,000 to 60,000, you are taxed at the 10% bracket. But from $60,001 to $80,000, you're taxed at the 15% tax bracket. But you made $75,000. That's in the middle of the second bracket. The first 60,000 will be taxed at the 10%. But you made 75. The next 15% is taxed at the next tax bracket. So it's not just a whole thing. So that's why it's kind of complicated, and you have to get professional help sometimes to maneuver these things. The next thing, standard deduction, again, very important, is what the government gives you based on your filing status. But your itemized deduction is made up of 4 or 5 things. And now remember, deductions are money you spent. Itemized deductions, if your itemized deductions are more than your standard deduction, you get to take your itemized deduction. But if you don't have the items that are itemized, then you automatically will take the standard deduction. What are the things that make up your itemized deduction? Contributions to a not-for-profit, like your church, your tithe and your offering. Now, the other thing, let me tell you all of them and then let's continue. Contributions to a charity, mortgage interest, property tax, major medical health expenses. Why do I say major? Because if you make $100,000 and you have $10,000 worth of medical expenses, you may not get any deductions. Why? Because you have to get over 7.5 or 10%. You have to have spent up more than 7.5% of your income to get that deduction. So let's say you made $100,000, 7.5% is how much? $7,500. You have to have spent more than $7,500 to get that medical expense as a deduction. Are you with me? If you have medical expenses, what are the things you get in the medical expenses as deduction? Transportation to the hospital. Hotel stay because of going to the hospital. If you had to modify your house, let's say you had to put in a wheelchair accessibility because of medical expenses, you get those deductions. Let's say you had to buy gas or get the ambulance. Those are things that are deductible. Again, 4 things. 4 things or 5 things. I don't remember how much, but 4 or 5. Medical expenses, major medical expenses, property tax, mortgage interest, charitable contributions. Charitable contributions to a not-for-profit, 501c3. Some of us are giving money to some offshoot people who don't have their ducks in a row. Get yourself in a row. And make sure you're giving to a legitimate organization that then gives you a letter at the end of the year. You have to get that letter. Because if you don't get the letter and the IRS says, hey, you see, I saw that you took itemized deduction, show me the proof of the charitable contribution. Mortgage interest and property tax, that's easy. Anywhere in the world I can pull up people's property tax information because it's public record. But charitable contributions, you have to have gotten the letter. All right? That is the reason why Summit, Acreage, wherever you go as a church, we give you those letters at the end of the year. Now, let's say your mortgage interest, property tax, your charitable contribution, major medical expense is more than your standard deduction. Then you're taking itemized and not standard deduction. When I just came to the country, somebody told me that as a nurse, you can take your uniforms as itemized deduction. Let me tell you from now, no, not go so. Sorry, let me say that in proper English. Nothing, no go so. I'm sorry. All right, that's not true.
One more time.
Sorry?
Say that one more time.
I was told, let me say it again. I was told that you, as a nurse, you can take your scrubs and your shoes and those things you wear as uniforms as itemized deduction. That's not true. All right? What about? Sending it to the cleaners, no, unless you have a business. Those things are not deductible. So you get the standard deduction or the itemized deduction. Standard deduction, again, is based on your filing status. Let's say you're single, it's $13,850, and your mortgage interest is $10,000. Your property tax is $5,000. Already, that's $15,000. Boom, you're over the limit of the single standard deduction. You are going to take itemized deduction. All right? Now, always check it during the year. Ask the treasurer, how much money have I given? Or just make sure you're writing a check. Make sure and brethren, it's good to give, but give sensibly. Give sensibly. If you're going to get a letter to get back, if the government says it's okay to put this on your tax return, then take it. All right? All right. So then you have taxable, and I'm sorry, I'm at 6:30. There's so much to share with you. I haven't even touched tax strategies yet, but let me just finish up quickly. Let's go to the next part of your taxes. That's where our credits come in. By the way, let's move to, yes, there we go. On your computer, on your screen, you will see line 25. That's where your income tax now is going to be calculated based on, I'm sorry, that something is missed out there. There's a part that should be, all right, let's go back to the other slide. I'm sorry. That one on your screen is where your tax is calculated. Line 16, it says tax. That's where your tax is calculated based on your taxable income. And then after that, it adds on the other taxes that you owe, such as self-employment tax. Those are additional taxes. Let's move to the other slide. The other slide now says these are federal income tax withheld from your W-2 or your 1099 or wherever else taxes are withheld. Those taxes now are subtracted from their total tax liability. Let's say, again, your total taxable income after you took your deductions is $20,000. Your tax rate is 20%, so you owe $4,000. But you took $6,000 from your W-2. So you owe $4,000, but you paid in $6,000. Automatically now you get a refund of $2,000. That's how you know how to get if you're getting a refund. Always look at the bottom where it says sign here. Let me tell you something, brethren. Always, always, always sign your tax returns. Always sign your tax returns. And sometimes during the year, just call the IRS and ask them, have you gotten my 2023 tax return? You got your refund, brethren. But ask them still. Call them and ask them if they got if they've gotten all your years of tax return. Reason being, somebody might have filed on your behalf and somebody might have stolen something. Something may have happened. I've heard some weird things happening at the IRS. I couldn't even tell you. So sometimes just call them. It might take you 10 years to get through to them. I'm sorry, but just call them sometimes and just say, hey, have you gotten all of this? Something that's important. I don't want to, there's so much here. Adjustments to income, IRAs. Your Roth IRA, there's two types of IRAs. Not two types of individual IRAs. There's a Roth IRA and a traditional IRA. Roth IRAs do not give you any tax benefits. They don't. Traditional IRAs give you a tax benefit. Let me explain. Traditional IRAs, you pay in the maximum. 2023, it was $6,500. Let's say you pay in the $6,500. You get a deduction for that money you paid into the IRA because it's pre-tax dollars. All right? Actually, no, it's post-tax dollars because you already paid taxes on it, so you get a deduction for that. You paid it into the IRA. The Roth, you paid in, but you don't get a deduction for it now. But later, when you take money out, you don't pay taxes on that money because you would already pay taxes on it. So that means I need to switch what I just said. The Roth IRA, you would have already paid taxes on it. You don't get a benefit. So later when you take out the money, you don't pay any tax. But traditional IRA, you don't pay taxes on the money now, but you pay the tax later when you take it out. All right? All right. I don't want to stop here, but I have to stop here so that you can ask your questions. One final thing. I see so much here on the slide that I need to tell you about. Earned income credit is for people who do not make a lot of money, but you may have a child or something, you get what is called earned income credit. Sometimes I've seen people get up to $8 and $6 or $10,000 worth of earned income credit. That's a credit again. Remember, credit affects your taxes dollar for dollar. Deductions affect your taxes based on your tax bracket. All right? I'm going to pause here. Let me take some of your questions, and let me see how much I can answer you. Do you see how taxes are nice? It's just so exciting, really. When you know what you're doing, it's exciting. All right. Anyways, questions.
Oh my God, that was open.
Go ahead, Sister Dyer.
Oh my gosh. Okay, so Elder, when you're filing jointly, how is that tax rate applied to both incomes? Is it separately applied, or is it just to the one income?
If I heard you correctly, when you're married filing joint, does the tax bracket apply to based on the separate income or based on the income cumulatively? Is that what you asked?
Yeah, that's the question.
Beautiful. It's just like in the Bible. When you get married, you're no longer twain, but you are one flesh. The IRS subscribes to that biblical principle when it comes to your money and married filing joint. So it's considered on a cumulative basis. All right? Very good question. Never even thought about that, but that's a good question. Next, anybody else?
Edson.
Yes, sir.
So obviously, there's a balance, and this is why you recommend hiring a professional to understand, like, okay, it's not good reasoning to say I don't want to earn more because I may potentially be in a higher tax bracket.
Yes,
that
sir.
doesn't make sense, right?
Yes.
And obviously, at some point, the deductions are less of your concern based on your earned income than the credits. The credits are what are going to make the more impact.
Yes.
Because it's dollar for dollar. You're not playing with percentages, right?
Right.
How does one, in layman terms, reason how to strategize earning more? We all want to earn more.
Beautiful.
Right? But I mean, and I'm sort of playing off something you told me when you prepared my taxes.
Yes.
A W-2 income is not the best way to earn
yes, sir.
large sums of money, right?
Very good question.
My question is, you
yes.
know, how do you balance that? I'm sorry.
And let me tell you something. This is where I get so excited to start talk. I'm going to have to learn to cut myself. Because here's what happened. I'm going to tell you this. Everybody, listen up. When you earn a W-2 income only, you have little ways of affecting your tax life. Everybody have a tax life. But if you only earn a W-2 income, there's not much ways. You can increase what they take out of your pay, but now you have to balance your daily life with less money. Or you can contribute to your IRA, but you still are going to have to balance with less money. Or you can pay more into your church or your not-for-profit. You still have to. So you realize what I'm saying here is that everything you do with a W-2 is to spend more to pay less at the end of the year. But what I always encourage people to do is to think outside the box and start a business. Start a business. That's one of the simplest answers I could give you. Let me tell you how it works quickly. When you start a business, the government says, the IRS says, and listen to these words, the IRS says, you can now take as a deduction everything that is necessary and, no, not ordinary. That is
legal.
Good. But let's use that term, legal and necessary to run your business. So now what the IRS is basically saying, brethren, is that you have now the opportunity to take those personal expenses that you used to spend for your lunch, your fuel, your repairs on your car, the electricity at your house, the water bill, the mortgage interest, the property tax, All of those things. When you run a business out of your house, the IRS says, hey, you are running the business out of your house. You can take a portion of your home expenses as business expenses. And now, instead of focusing on spending more, you are spending the same, but you're reducing your taxable income. Do you understand what I'm saying? So the best way, brethren, is to, 1, start a business. 2, diversify your portfolio, which means put some of your money in some things that are guaranteed returns, but not necessarily aggressive returns all the time. People always are thinking about making money quick. That's not how people get wealthy if they're talking about building wealth. That's not how people get wealthy. It's slow and steady wins the race. Take your time, build up, and do something. Now, the other thing to note, brethren, and we as Seventh-day Adventists and as Christians, one of the main things, and my mother-in-law asked me about this, she said, how are we going to teach people to come out of debt? How are we going to teach people to come out of debt? And you know, as Seventh-day Adventists, we have a specific message about coming out of the cities, going into country living. How do we help people with that? I'm going to tell you something. If you are intending to buy property and do stuff like that, you need to get with a professional to help you to learn how to set these things up. All right? Because you may form a not-for-profit, you may form a partnership or a single-member LLC, buy the property under it. Every year that property tax that you're going to pay is tax deduction on your business. Do you understand what I'm saying? But if you buy it under your personal name, the property tax is just money you're spending. And by the way, if you pay property tax on a second property that you own, that's not deductible as an itemized deduction. Only your primary residence is deductible as itemized deduction. So one of the ways, Mr. Duggins, hope I'm answering your question properly, is to start a business, diversifying your portfolio. Start a business. If you're into real estate, put properties under a business. If you intend to own several properties, get a partnership, get a trust, get something of these things which are able to protect these assets, and therefore the expenses which are always in your daily life, your food, your gas, your car repairs, those things that you clothes, all of these shirts, if you notice they are logoed, these are business expenses, and I still wear them every day. All right? So I don't need to worry about it because these are run under the business. So what I'm saying, these regular daily expenses become business expenses. They give you, you still have to spend for them, but they reduce now your taxable income. All right? Any other questions?
Thank you.
You're welcome. Any other questions?
I have a question.
Sorry?
I have another question.
Yes.
What kind of educational deductions can you make? Well, how long has the course got to be? Has it got to be a full 4-year college
Sister
course?
Dyer, I'm not hearing you clearly.
Well, I'm asking if the educational deduction, has it got to be a full 4-year college course?
If the
I'm just
Yes.
asking if there's a specific length of time ascribed to whatever courses, educational courses you do in order to get credit for it.
Well, and remember, education is not deduction, it's credits. Education credits. It's a regular 4-year college, or it's a college course, maybe 2 years or 4 years, that you are paying tuition to a qualified institution. So there are some institutions that are not qualified because they, I don't remember what the reason is, but you, like state colleges, state universities, all of those qualify.
Accreditations.
Accreditation is one of them, yes. It's one of them, yes. But there are some other reasons why sometimes private institutions are not, because they're private, and I don't remember what the reason is. There's something else I need to bring up here. Some people always ask me, does my child's tuition at elementary school, at a private elementary or private high school, count as these deductions? No, they don't. It has to be a 4-year university or undergrad, graduate level program. Those qualify. Your child's tuition at high school, elementary school, or below, The only thing you get for those are after-school care things. All right? Those don't count.
Yeah, but Edson, to
What
clarify.
about a trade?
Yeah, question. What about continuing education for like, if you're a professional and you have to take some college course or something in order to remain certified, or you just need to like, expand your knowledge base?
Beautiful. Some of those things are not deductible either. They are, again, it has to be a 2-year. Some of these certificate courses are not. It has to be a 2-year course or a 4-year course or something like that. That is from an accredited organization. If it's a continuing education, like I have to take, how much is it? I don't even remember how much continuing education. I think I have to take 40 continuing education every year or something like that. Don't remember how much. But those continuing education, that's the reason why I always say to people, start a business. If your business is based on your qualifications or your certification, those become expenses the business can pay for. But if you are working for someone, you're a W-2 employee, and you're working for someone who requires your certification to maintain, to make their status look good in their company, they should be paying for your continuing education. But if you are working as a 1099, a contractor, and you are a civil engineer, design, home designer, what they call interior decorator, and you need to maintain your license, your certification, all of those are deductible expenses on your 1099. All right?
What about a trade school? Would that still count?
Trade schools will count, yes, if they are accredited. And remember, how do you have to ask those questions. Some trade schools do not qualify. Like, for example, going to a truck driving school, that doesn't qualify. Most of these are just giving you your CDL. That's just that's a driver's license, but you are qualified to drive bigger truck, big rigs. Those don't qualify. Some of the trade school for carpentry, which is like a year program, a 6 months program, some of those don't qualify. FAU is a state college, but they offer courses that don't qualify for the education credits. All right? Any other question?
Sorry
Yes.
to keep speaking, Edson.
No problem, no problem. We have a question in here as well, but go ahead.
Go ahead there.
She has a question there. Over there, yeah.
Is it on?
It's on, right?
Is this on? Yes.
Yeah.
What about medication? Is it a part of medical expenses?
Medical expenses, yes. Medications, dental office expenses, prescription medication is the same thing. Dental offices, what else? Transportation, dental, eyes, your regular doctor's visits, as long as they are over that limit, 7.5%, over 7.5% of your income, yes.
What about vitamins?
No. If they are just vitamins, over-the-counter stuff, no, they aren't. Thank you very much for your question. Sir Duggins, you were asking a question again.
It wasn't a question, Edson. It's more so an observation.
Yes.
In that, in order to, you can just utilize this tax system in order to be more financially strategic. You don't necessarily have to be doing a lot of things different, in that they're just better strategies for spending the same money. You understand, like how
Exactly.
you're referencing, you're going to spend that money anyway.
Exactly.
Just do it in a way
Yes.
that benefits you because it's
Yes.
legal.
And here's something to note. The IRS says this. The IRS says this. If you have a single member LLC, let's say, brethren, it's so easy, it's not even funny sometimes. It's funny, but it's not. Let me explain something. You can get up today, form a LLC, sell some stuff. I have a client that all she does is goes to thrift stores, buy thrift store stuff, goes on one of these websites, does stuff online, sells these clothes. And she works. Otherwise, she formed a LLC. You know what? How the deduction she's gotten? home office deduction. She uses one of the rooms to store the clothes. So a percentage of her home expenses now become deductible. A percentage of her mortgage. Let's say on your taxes, you didn't get enough expenses to itemize, which means your mortgage interest, your property tax, your charitable contributions to the church, they don't matter anymore because you have to standardize. You are married filing joint, 27,700 standard deduction, your itemized deduction, all the money you spent on property tax, mortgage interest, and charitable contribution and medical expenses were 27,500. You now have to standardize. But you still have 27,500. What do you do with that? When you own a business, a single member LLC, specifically a single member LLC, a percentage of that $27,700 now becomes deductible, even if you standardize. Do you understand what I'm saying? And that's money that you still have to spend. Now, what do? You're working a 8-hour job. You don't have the time. Find something still, brethren, to do on the side. Everybody has something that they love to do. Sure. Hold on. Go ahead.
In our community, very often we actually have sideline businesses. They're just not official.
Exactly.
You have so many people that maybe have a daycare. They watch a couple of kids and they get paid for it.
Yes.
That should be under a business. I know people, maybe they do car washing, but they're making money. So it's not necessarily thinking out of the box in a lot of situations. It's just actually professionalizing what you're already doing. Formalizing is the right word.
Thank you. I have another client. She is a travel nurse. She has to go to California. She lives here in Florida, and her mother watches her kids take them up. What she does, and this is how she organized it, she's paying her mother to watch the kids. She formed a business, run some of those things, those expenses to pay her mother through those expenses. It's not her mother's business to take care of the kids, but she has to pay somebody to watch the children because she's not there. So that money, she's paying it through the business to her mother. All right? So some of these little things that you do, you have a space, take a child to watch, charge them a small amount of fee, formalize it. You are using your home as a business. And those are some of the ways you go and you do healthcare. You're taking care of people as your job. You get a 1099. Your mileage becomes deductible. The fuel you drive to work, you get to drive to work. You're on the job and you buy lunch. That's deductible. You have to change your proper clothing. That's deductible. You have to buy proper shoes. That's deductible. You have to get a proper haircut because you're going into people's house. Your haircut is deductible. You have to, let's see what it is. Whatever it is, as long as it has to do with the business. Remember, it's reasonable is the term, reasonable and necessary, the government says. And they specifically say meals. Why do you think these wealthy people travel so much? They're traveling for business, and they're traveling business class, and they take hotel stays, and they do this and that. Where do you think it's going? Under the business. Are you with me? So they are doing things outside of the box that is now able to be, it's regular spending. It's regular spending. You are spending the money still. Why not do it in a way that the IRS says, thumbs up for that, that's fine, keep it legal, we're good. Here's something the IRS says. A matter of fact, is there any other question? And then I tell you one thing that the IRS says about LLCs. All right, let me explain something that the IRS says about businesses. If you have a business, single member LLC specifically, that makes losses. Now remember, let me explain this. You have your total income from your W-2. If you made a loss, you have your total income of $100,000. You have a Schedule C as well. You have a business. In the business, you made $30,000, but you spent $40,000. Which means your expense is more than your income. You made a loss of $10,000. That $10,000 is going to the front of your tax return to reduce the $100,000 W-2 income that you made. All right? And that's part of the power of business expenses. Now, how do you reduce those? How do you make sure that you can? You don't have to make sure you're reporting losses on your business, because here's something to note. The IRS says if you make losses for 3 consecutive years, they're going to change you from a business to a hobby. To a hobby. And when you become a hobby, all of your expenses are no longer deductible. All right? So you have to watch that for 3 years. We're up to 2 minutes before 7 o'clock. Any other questions? All right. For those of you who own a business, sorry, go ahead.
I'm sorry, it's just fun. I want a hobby.
No problem. What did I hear you correctly? She unmuted by accident. For those of you who own a business, here's something, and these are some of the things that people don't know, so I'll just share something. There's this rule that's called the Augusta Rule. I'm going to ask you to look it up. Augusta. Augusta Rule. When you own a business, that becomes important. Augusta Rule. If you own your business and you meet people at your house, right? Even if you don't, but you have meetings with your employees at your house, or you met with a business partner at your house, the IRS says you can charge yourself up to 14 days rent for those meeting expenses, for using your own home, for business meetings. And how much you charge is based on going rate in your area. And that money is not taxable to you any at all. It becomes a deduction for your business. So let's say you charge yourself, like based on some of the areas that I see, you charge yourself $300 a night because it's Airbnb. And you charge 14 days. Let's do it simpler. $200 a night. 14 days, that's $2,800. You pay yourself $2,800 out of the business. That's $2,800 of expense to the business. It's income to you, but that income is not taxable. All right? It's called the Augusta Rule. All right? So these are some of that. It's up to 7 o'clock. We have to close. But let me tell you something. If you, let me see. I think there's a slide there with my information that's way down at the end. It's slide number 81. If you want to get in touch, ask questions or something like that, you're welcome. I see a Zoom message. I think it's slide number 81. There needs to be a part 2. I think so too. There's a lot that needs to be said. There it is. Thank you very much. That's my information. That's the company name, Gordon Associates CPA PA. That's the name we put out there, and that's the website. If you have questions, you can go to the website and send a contact request. You can give us a call and also send an email. Or if you're in the Port St. Lucie area, we'd definitely like to see you. Come and visit. But there are no other questions. We thank you so much for coming on. Really, really appreciate this opportunity to be of blessing to you all. Let's bow your heads where you are. Let's pray. Our loving Heavenly Father, truly you have given us our skills, our knowledge to be a blessing to others. As Moses was in the wilderness going to build a temple, you called Bezaleel and Aholiab, and you put your spirit within them. And you told Moses, I have put my spirit in Bezaleel and Aholiab to build the sanctuary with skill and with beauty. I pray, O Lord, that while we may not be building a physical sanctuary, we may be building a financial sanctuary for you with sensible knowledge that we can pass on this wealth to better your gospel, your message in this world. Our intent is to build up your kingdom, and not just to put more money in our pockets, but to be a blessing to this world through the gospel. And we ask you, Lord, that you will continue to guide us in our professional situations, that we can now come to be a blessing to everyone with whom we come in contact. go with us now as we go. And we thank you for this opportunity to share, we pray, in Jesus' name. Amen. Amen. All right. Thank you very much, everybody.
Thank you.
You are welcome. And again, we definitely will be planning part 2, but you will hear about it. All right?
Are we meeting next Sunday as well?
Yes, I must apologize. Thank you so much for asking that, Mrs. Duggins. We're meeting next week for the final presentation, which is from Chanel, the financial advisor. And we're at 5 o'clock next week, right here, same place on Zoom. She's going to talk about all this stuff about financial planning that you guys need to hear and we all need to hear. All right? Thank you very much, and see you all next week.
Thank you.
All righty.